Everyone knows about QE, or what we always call it, printing money. But today we're going to talk about the opposite of it, QT. Okay, no, not this QT cat, but QT, aka quantitative tightening. You know, the reason behind why interest rates are rising like crazy. Alright, so in this video today, we will explain what QT is and the impact it has on the stocks. But before we begin, do subscribe to our channel and give us a like for the videos. In return, I will share with you a financial meme. With that, let's dive in. So first of all, here's a quick background of what happened prior to quantitative tightening. So due to the COVID pandemic lockdowns, many businesses are affected and people are out of jobs, etc. The US government decided to lower the interest rates near to 0% and print money via QE, quantitative easing, and give it all to the retail investors. So a lot of retail investors, they have those 1,200 paycheck from the government itself. And all these measures are to revitalize the economy battered by the COVID pandemic. Right. In fact, there have been 4 phases of QE stretching all the way back to year 2009 during the dot-com bubble back then. Okay, so anyway, as we live with COVID and things got back to normalcy, people start to use this, free money and plow them into stocks, into crypto, Bitcoin, and even real estate. So they're driving all these asset prices to all-time highs. And in return, okay, many investors got rich also. They become very wealthy. However, all good things must come to an end, and this is the same case here. Inflation soared to near 40 years all-time high in the US because of the supply chains disruption, an ongoing Ukraine war, and extreme weather conditions. So hence, US has to reverse the course and instill QT or higher interest rates to suck up the excess liquidity in the economy and bring down the fast pace of growth. So let's talk about what is QT. Okay, so in technical terms, QT is a contractionary monetary policy tool. Okay, they are used by central banks to reduce the level of money supply, the liquidity, and the general level of economy activity. Okay, this process is also known as balance sheet normalization. However, in layman terms, QT is a measure of sucking out this liquidity from the economy. So how does the Fed get to doing all this? So basically, they have 2 options. The first one is to sell new US treasuries. So treasuries are government bonds of various maturities. Okay, and investors normally look at them as a form of risk-free investments. And hence, they will always try to get their hands on them. So essentially, investors buy these securities from the Fed. Their money moves out of the economy, so from my pocket, from your pocket, into the hands of the government. So there is less liquidity in the market, all right, floating around, or less money floating around. The second way they're gonna do that is to retire existing treasuries. Okay, so in this aspect, right, they are gonna let the treasuries retire and not issue new replacements at the current interest rates. When this happens, the government literally removes them from their cash balance, okay, from their balance sheet, and the money they have created effectively disappears. And so these are the 2 mechanisms by which the US Fed, right, executes their QT policy measures. While we understand how the process of QT works, okay, the next thing to know is their impact on our lifestyle, on our investments, and henceforth, right? So the next one, all right. If we were to look at this chart over here, right, on May 2022, the Fed actually announced that it will embark on QT from March to May, right? They say that, okay, we're gonna start to kick off this, reducing of the money supply in the whole economy to to stop the inflation or to curb this high inflation going on. And you can see from the image itself how the balance sheet started dropping right after they announced that policy. Okay, next. All right, let's talk about the impact on both the consumers and the stocks or the companies itself. First thing first, all right, to put things into perspective, when the Federal Reserve announced price hikes for their federal funds rate, it is increasing the interest rate at which the commercial banks lend to one another overnight. In return, commercial banks will charge higher interest rates for business investment loans as well as consumer borrowings such as mortgages and car loans. Right. So when you borrow these are either personal loans or car loans or housing loans, you're gonna pay higher interest rates for them. So imagine, right, how much more you're gonna pay due to a few percentage jump in the interest rates. So this is a huge impact to consumers. And while the interest rate impact is obviously gloomy on the consumption side, it may be different on the business front. All right. And investors can look at this impact to the businesses from two different lenses. Right. So now let's talk about impact to the stocks. There are two ways to look at stocks during QT. All right. The first lens that we're going to look at is those aggressive firms. All right. They are those, they have used cheap funding to expand aggressively, grow at neck break pace during the COVID pandemic. All right. And back then they are borrowing at, near 0% interest. But however, after the interest rate hike, they are feeling the heat right now because when they have borrowed a lot, all right, and now they need to pay back higher interest rates, they're gonna have to fork out more, more cash outflow to pay for the interest payments. And coupled with the easy money from all those private equity funds, drying up, they now have to fend for themselves. And for those loss-making companies, where are they gonna get all this, dry powder, right? So in addition, right, the poor business outlook, okay, because right now everyone is talking about layoffs, going to recessions, the very poor outlook and their previously high valuations are eating into their growth. So if we were to look at it, popular stocks, like maybe the Snowflake, all right, like Netflix, like Meta platforms, they are all down, like 50 to maybe 70% in a single year. And all these businesses are facing the headwinds in QT. All right. On the other hand, right, we also can look at companies that profit from rising interest rates. So these are opportunities on the other spectrum, on the opposite side of the spectrum. For example, when we look at financial institutions, all right, like banks and financial services lenders, they are going to benefit from the rate hikes because they can earn higher income from all these loans. One prime example is how DBS can make almost $1 billion in net interest income simply from an increase of net interest margin from 1.65% in first quarter 2022 to 2.3% in third quarter 2022. And that's not even 1% hike in the net interest margin. Imagine what can happen when it goes to 3 or 4%. All right. So defensive lending and asset quality concerns also increase business activity in other peripheral activities like insurance, brokerages, and rating agencies. For example, all right, if we were to look at the US stocks, like Charles Schwab and Bank of America. Okay, so sorry, it's BOA, right? Um, they have more than for Charles Schwab, more than 50% of their net revenue is tied to interest rates, and 100 basis points rate hike overall can boost their net interest income by 12%. All right. Similarly, if you look at Bank of America, okay, in a regulatory filing, they say that 100 basis point increase in interest rates will help their net interest income to grow by $5 billion over the next year. So these stocks, right, these financial stocks can probably give your portfolio an edge of outperformance in this QT scenario. All right, another thing to look at, all right, is perhaps defensive or high quality stocks that have pricing power. Okay, one very good example is McDonald's. All right, just recently I went to buy an Oreo McFlurry for my kids and realized the price went up again. All right, back then I still remember Oreo McFlurry maybe is $2, but right now it's like $2.90. Wow, it's almost like 50% increase for just maybe 2-3 years, right? It's crazy, man. So on because of that, right, I actually went to compare the price increase of a Big Mac, all right, based in the US lah, versus the CPI inflation index. So the CPI inflation is the usual inflation rate of the economy versus that of a Big Mac price. And based on this chart itself, you can see the price of a Big Mac is increasing faster than inflation. No wonder McDonald's can keep charging higher prices, and their share price has to keep rising in the long term. Okay, then another one, all right, if we were to talk about quality stocks, we can look at stocks with a strong economic moat. Think about what products or services you will continue to use even during a recession. For me personally, my work purposes, it has to be Microsoft and Zoom, because I use Microsoft Office, Word, PowerPoint, and all that, and I use Zoom to do work meetings, to even connect with third parties, right? And for my own leisure or my own purposes, I use Alphabet, right? Alphabet, of course, I'm using the YouTube to do all these videos, and on top of that, I use Gmail, I use Google Maps and all that. So this is definitely, they have a lot of services that I use for Alphabet itself. And recently, like now that COVID is no longer a threat, we are also going to travel around the world. All right, my wife has been telling me that once a year is not enough. We must go out more to compensate for the time that we have lost in the COVID years. And so, we have already been booking a lot of travel trips. And one company, or rather the service provider that I use, is Agoda, or its parent company Booking.com. So in order to travel around the world and book hotels, you need Agoda. So these are companies, with strong economic moats that you can perhaps look at during this, perhaps the downturn that is to come. Okay, so to summarize things very quickly, okay, QT is an after effect of the high inflation, but given the humongous debt of the US government, it's safe to say that the interest rates may not go back to zero anytime soon. Okay, so in fact, there are a lot of people that, a lot of economists or analysts saying that the normalized interest rates in future will be around 2-3%. And this effectively means that the era of easy money is gone. All right. And what we can do as investors is to perhaps look at defensive or high quality stocks with a solid balance sheet and can churn out free cash flow for their continued growth in the future. Hope that you have enjoyed this video. If you want more tips and advice on how to invest for the better, be sure to subscribe to our channel and hit the bell notification. Alright, next up, you can also watch this video if you want to find out more about TSMC, the rare tech stock Warren Buffett bought in year 2022. I will see you next time.